Afcons Infrastructure Q4 FY26 earnings call hosted by DAM Capital Advisors. As a reminder, all participant lines are in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kishan Mundra from DAM Capital Advisors. Thank you, and over to you, sir.
Hi. Thanks, Alaric. Good morning, everyone, and a warm welcome to the Q4 FY26 earnings call of Afcons Infrastructure. So today we have the management with us, which is represented by Mr. Paramasivan Srinivasan, who is the Managing Director, Mr. Ramesh Kumar Jha, the CFO, and Mr. Hitesh Singh, the Head of Corporate Strategy. Now at this point, I will hand over the floor to the management for the initial remarks, post which we will open the floor for the Q&A. With that, over to you, sir.
Thank you, Kishan. Good morning, ladies and gentlemen. I welcome all investors, analysts, and participants to the Q4 and Financial Year 26 earnings conference call of Afcons Infrastructure Limited. We appreciate your continued support and participation today. Our financial results and investor presentation for the quarter and year ended March 26 have been uploaded on the stock exchanges, and I trust you had an opportunity to review them. Joining me today are Mr. Ramesh Jha, our CFO, and Mr. Hitesh Singh, our Head of Corporate Strategy. Financial Year 26 was a challenging year for the infrastructure sector, and the overall performance during the year remained far below our expectations. First of all, I apologize to all the investors that we have made a loss in a quarter for the first time since we started publishing quarterly numbers from 2010. We view this as an exception. In fact, it will not be out of place here to mention that I am personally deeply upset with the results, and I am sure that this could be an aberration or a one-time exception and will change. For the year, revenue stood at 12,322 crores, reflecting a decline of 5.4% year-on-year. EBITDA was rupees 1,439 crores, and despite the moderation in performance, we maintained a healthy EBITDA of 11.7%. This continues to be among the better margins in the industry. Profit after tax stood at 251 crores. After providing 76 crores for a one-time impact arising from the implementation of the new labor code, if we exclude that, that will be 327 crores. For the fourth quarter, revenues were 2,777 crores, while EBITDA stood at 170 crores. The quarter closed with a net loss of 89 crores, impacted by certain project-specific developments, provisions, and one-time factors during the period. The year was characterized by slower than anticipated ordering activity across several segments, delays in project conversion, prolonged tender evaluation timelines, and execution-related disruptions in certain projects. Our top line during the year was also impacted by continued liquidity constraints at the client level, which affected execution momentum in some projects longer than anticipated. In addition, certain overseas projects witnessed temporary disruptions during the fourth quarter due to geopolitical developments in the region. A few projects that were expected to ramp up during Q4 also experienced delays arising from the design and alignment related changes. Taken together, these factors had a meaningful impact on the revenue growth and profitability during the year. However, we continue to view this as largely timing related and external factors rather than structural issues in the business or our execution capabilities. Despite these challenges, we continue to make progress across several strategic and operational priorities. During the year, the HRRL crude oil terminal project at Mundra, part of one of India's largest integrated refinery and petrochemical complexes, was commissioned, reflecting our growing capabilities in industrial and energy infrastructure. We also witnessed the operationalization and inauguration of several infrastructure projects completed by Afcons during 26, including sections of the Bangalore double-decker metro and flyover corridor as a part of ongoing elevated metro project. This section was executed within one of the world's and Bangalore's busiest live traffic environments with minimal disruption to city traffic. Sorry. In addition, successful trial runs were conducted on our Agra and Kanpur metro project, while Delhi-Meerut RRTS corridor, where Afcons executed 2 packages, became fully operational. Our execution capabilities and institutional strength also continue to receive recognition during the year. Engineering News Record USA ranked Afcons 8th in marine category globally and 12th in international bridge contractors, reinforcing our position in technically complex infrastructure segments. We were also honored with the prestigious Mike Award for the 8th consecutive year, and overall the 10th year if you take Mike and Make together, reflecting the institutionalization of knowledge management and innovation practices across the organization. Turning to our own internal business, I am pleased to share that we have received a proposal for the rehabilitation and construction of the railway line project in Croatia, for which we were declared L1 last year. We expect the related formalities to conclude shortly. As disclosed recently to the stock exchanges, the 2 Croatia road tenders where we were declared L1 have been cancelled by the client due to budgetary constraints. While this is disappointing, we continue to remain positive on the long-term opportunity in the region. On the Mumbai-Ahmedabad high-speed rail C2 project, the second consignment of the tunnel boring machine, which had remained held up for several months, has now been received at site. Assembly activities are progressing well, and the main drive has already been lowered into the shaft. We expect tunneling operations to commence before end of next quarter. Coming to order inflows during financial year, we secured new orders worth 4,125 crores, excluding approximately 3,800 crores of variation and change orders received on existing projects. The order intake was below our earlier expectations, largely on account of deferment of several large project awards and delays in conversion of L1 positions into firm orders, particularly in the fourth quarter. You would have noticed that we have booked around 8,000 crores of orders and declared L1 in another around 7,000 crores of new orders so far in this financial year. We expect these L1 orders to get converted in this quarter. With this, last year order booking guidance backlog will be completed in the first quarter of this financial year itself. That said, we have seen encouraging progress on some of these opportunities, both in domestic and international markets, in recent weeks. Our addressable pipeline remains robust across key segments: transportation, marine, underground, hydro, water and industrial infrastructure. Having a certainty of about 15,000 crore order including L1 in the current financial year, we expect to book another 15,000 crore of more orders, making a total order booking guidance of 30,000 crores for the current financial year. At this stage, considering the continued uncertainty in the geopolitical environment, elongated award cycles, and ongoing project-related developments, we believe it would be prudent to wait for greater visibility before providing specific revenue growth or EBITDA margin guidance for financial year 27. To conclude, while financial year 26 was undoubtedly a difficult year operationally, we remain confident in the long-term fundamentals of the business. Our diversified presence across sectors and geographies, strong execution capabilities, healthy opportunity pipeline, and disciplined approach to growth position us well to navigate the current environment and capitalize on opportunities as sector conditions improve. With that, I now invite our Chief Financial Officer, Mr. Ramesh Jha, to take you through the financial performance in greater detail. Thank you all.
Thank you, sir. Good morning, everyone. Before talking on the numbers, let me reiterate that our quarterly number varies. Company is into the business of construction. The margin in a quarter varies based on the nature, type and quantum of work executed. So quarterly results may vary in different quarter and may not be indicative of the annual result or trend. Now moving into the specific numbers, in Q4 FY26, we had a total income of 2,777 crores, This is 18% down as compared to Q4 FY25, wherein we had done 3,387 crores. For the full financial year, we have done 12,322 crores, which again is 5.4% down from the previous year 25, wherein we had done 13,023 crores. Now, specifically in Q4, we have seen that the payments were not coming from the customers. Payments were not very smooth from majority of the customers. Working capital funding to the projects continued in Q4 as well. And under the circumstances, we decided to balance between funding projects and maintaining liquidity. So we funded projects up to a limit, but we had not gone beyond the point to avoid overexposure to any customer. This limited our turnover in some projects. Also, in Q4, there were after the war, there were fuel and gas-related issues in projects, consumables and logistics-related challenges. Especially, this was in the overseas market, which kind of marred the planned progress. Usually, we have seen that in Q4, we do at least 15 to 20% turnover more than Q2, Q3, and that is backed by smooth payment from the customers. And that gives us the benefit of economies of scale and improves profitability significantly in Q4 and then impacting overall year performance. However, this year was a contrary effect. It was one of the factors which has impacted the bottom line also during the year. For the full year, we achieved a turnover of 12,372 crores, which is a drop from previous year top line. This year, we could not achieve the planned turnover from various projects across domestic as well as overseas. So on an overall basis, if I have to put it in a nutshell, there were payment issues, L1 orders were not converted, some of the fast-track projects not picked up, and certain geopolitical issue were the main reason impacting the revenue growth. Now moving on to the EBITDA, during Q4 we had done absolute number 170 crores of EBITDA, which was quite significantly lower than the previous year's 415 crores. In terms of percentage, in Q1 it was 6.1%, and for the overall year, the absolute number of EBITDA was 1439 crores, which is 11.7%, as compared to last year's 1662 crores, 12.8%. So on a year-on-year basis, it was down by around 13.4%. Now, in our EBITDA calculation, we consider the BG commission as part of our operating expenditure. So EBITDA, what we are talking about, is after removal of BG commission as an operating expenditure. This year, because of overall reduction in our interest rate, the finance cost, even though has gone up, which I'll talk about when I talk about the finance cost. Also, our EBITDA calculation includes other income as part of revenue. Here we have explained earlier also that our other income is very much part of business. Arbitration interest, foreign currency exchange gain, miscellaneous incomes are recurring, and those are very integral to our business. Hence, this needs to be considered as other operating income. So for the year ended, a sizable amount of 374 crores, which is part of other income, needs to be considered as other operating income. Now moving on to profit before tax. For the full year, we have done 387 crores of profit before tax, which works out to be 3.1% of the top line. And this has come down as compared to FY25, wherein we had done 710 crores, which was 5.5% in the previous year. And in profit after tax, for the Q4, we had done, there is a loss of 89 crores. However, for the full year, the profit after tax is 251 crores, which works out to be 2% of the top line, wherein in FY25, we had done 487 crores, which was 3.7% of the top line. Profits for the quarter got severely impacted because of sizable provisioning in one of the projects. And in another project, we incurred substantial extra cost on marine operations. Both these are, kind of one-off event. In addition to this, in some projects where we were expecting to cross the margin recognition threshold, usually in all the projects, once we receive a threshold of turnover, which is around 10%, then only we start recognizing profit. So in few recent projects, we could not cross the margin recognition threshold which we were expecting in Q4. We fell short marginally to reach that threshold, so margin could not be recognized. In addition to this, under recovery of fixed costs because of lower turnover, higher finance costs because of working capital lockup were the components contributing to loss in the quarter. For the full year, in addition to the above factors impacting Q4 profitability, labor code related one-off exceptional item was another big impact. Now, specific to finance cost increase, during the year we have continued to see payment related challenge. We have improved our average borrowing cost in FY26 as compared to FY25 because of the interest rate going down, and of course because of improvement in our credit rating as well. But during the year, the average borrowing has gone up as compared to previous year, and because of that, the overall interest cost has gone up, and this has a manifestation of working capital blockages. So despite improving the average cost, interest on bank borrowing has gone up. Also, the interest bearing advances for the full year FY26, which is around 40% of the overall advances from the customer, which even though in March 25 was also around say 38-39%, but then the interest on customer advances were not for the full year that 40%, because it gradually moved from say around 20%, which in September 24. It moved to around 38-39% by March 25. So for the interest bearing advance in last year there was not full year impact, whereas this year almost 40% of the overall advances were interest bearing. So that has got a bearing, and the interest from the customer advances has increased in this financial year. Because of this, interest on customer advances has increased, making the overall interest cost go up. We expect the situation to improve on realization of number of locked up assets, which we are in a very advanced stage at this point in time in many projects, and also on receipt of interest-free advances, mainly in international order. On the depreciation front, we continue to account for accelerated depreciation on our TBMs. Of the total 454 crores, the normal depreciation was around 289 crores, which is 2.33%. So rest of it is on account of accelerated depreciation. On tax, the tax rate on Afcons profit is around 35%. This is on account, and this is higher than usually one would expect. So this is on account of some of the JVs where we paid tax in the range of 35 to 36%. Also, in some overseas locations like Bangladesh, Gabon, tax is charged on turnover. In such situation, if you don't make profit above the threshold, your tax, the extra tax it needs to be charged off, which was the case in places like Gabon and Bangladesh. Beyond this, we had to make provision in one of the JV entities, which has brought the consolidated profit down, making that effective tax rate higher. Now, specifically on ROC, we have talked about that higher provision in one project due to arbitration development, extra cost on a marine operation in one of the projects, and non-recognition in recognition of margin in few projects due to non-achievement of turnover threshold, and also under recovery of fixed costs due to lower top line. This all has severely impacted the profitability, in turn impacting the ROC and ROE. In FY26, we have done around 12% ROE, and ROE is around 5%, which is quite low. In terms of debt, gross debt has remained in the similar range that of September and December, and that stands at rupees 3,538 crores, and net debt is 2,653 crores on the net basis. So on net basis, the debt to equity is around 0.49 times of the net worth. This is on the numbers. On behalf of Afcons, I thank everyone for attending this call. Now I request the moderator to open the floor for Q&A.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from Shravan Shah with Daulat Capital. Please go ahead.
Hi, sir. Thank you. Sir, you have tried to explain various reasons why our performance was one of the worst quarter in our history, but still trying to get some more clarity there. So when we had a call in the third quarter, post the result in February 11, we were kind of confident that we will be able to do at least 5% revenue growth for the entire full year. That means we would be doing a kind of a 19-20% kind of a growth on the fourth quarter, versus now we have seen a 19% degrowth in the fourth quarter, and for full year also 5% kind of a degrowth. So just trying to understand that even at the middle of the quarter we were so confident, and what has gone so wrong in terms of and that's why we missed significantly on the execution front.
That is correct. But see, usually what we have said, this was based on, say, last 15-20 years experience. What happens that in Q4, we have seen that the customers, they release all the payments up to date. This is what our experience has been for quite some time. But this year was an exception wherein we have seen that there was a slowdown in terms of payment, and payments were not forthcoming. That has impacted, and we had to decide a choice between growth or to preserve the liquidity, and then we had not taken that aggressive call to pursue the top line growth. And then in the midst of that, the war started, and then that severely impacted the supply chain management. And you are aware that even this year we have done close to 30% from our overseas project, even though the order book is lower in terms of order book composition, domestic versus overseas. But in terms of turnover, we continue to do around 30% from the overseas market. And some of the countries where we are operating are not that bigger economies where they have got higher amount of oil reserves. So the operations got severely impacted in the month of March. So POL related stuff and logistics related stuff. So we couldn't send material to project site, and this severely impacted. Even in domestic market also, you are aware that many of our projects are at remote locations. So availability of gas was a real problem.
Okay, got it, sir. So now again we are at the middle of this quarter. So first, obviously, I think correct me if I am wrong. For full year FY27, we are not providing any revenue guidance. So if that is the case, then this quarter Q1 till now, and looking at whatever the constraint, payment related issues, everything. Can we see a growth in the Q1 FY27 this quarter?
I see, this is where what we have conveyed is that at this point in time, because of the geopolitical situation, because the condition continues to be the same, even in domestic market, we are getting very contradicting signals. We are hearing that the energy prices are going to significantly go up. And we have not seen the payment situation improving significantly. Even though some of the stuck payments, we are, as I said earlier, that we are in a very advanced stage to get those payments. But at the same time, those supply chain related issues continue. So it would not be prudent on our part to give you any guidance as such for the full year or even for the Q1.
Okay, got it. So same for even for margin also, the normal long-term guidance that we have 11%. So that will also, we will right now will not be kind of giving any kind of a guidance on that front.
See, we are not saying, we are not giving any guidance on the margin front also, because we need to see how it actually pans out, because many overseas places we have seen that the petrol, diesel prices have significantly gone up during the war period. In the month of March, April, the prices have gone up. Some of the places like Bangladesh, they were having elections, so till the elections were there, the prices remained stable, but after the results, the prices had gone up. So we are looking at that kind of situation, and you are aware that in many overseas locations our prices are fixed price contracts. So we need to see how we are able to recover from the customer this escalated cost. So we have in past also explained that generally in overseas market we try to keep risk and contingency, but then at the same time we are not very sure to what extent those risk and contingencies will be able to take care of the escalated cost.
Lastly, sir, on the inflow front, just to get a number correct. So after the 31st March, how much value of inflow that we have received the LOA? Obviously, we also know, if you can also specify in terms of the L1. So what I know is Croatia, which would be a 7,800 odd crore, and the Vadwan one, which is 5,300 odd crore. So kind of a 13,000 odd crore kind of if you can specify the number would be better. So we are saying by June we would be getting a 15,000 crore LOA. That is one. And second, additionally, we will be getting a 15,000 crore more inflow. So total would be a 30,000 crore for the entire FY27.
Yes, so you are right. We have already informed to the exchanges that this Croatia order is already, we have been selected as the contractor for the project. And besides that, you are aware there are news in the social media that a couple of projects we have been declared L1. Since we are not disclosing that to the exchanges, we will not be able to give you the exact details. But you are aware, there are projects where we have emerged as L1.
There is also an underground metro of DMRC of 373 crores, which we have bagged already.
So and the yearly number what we are talking about, almost 50% is having a clear visibility in place in the first.
Okay, got it. And the capex for full year now, given the FY26, I think the TBM cost now would be shifting in the FY27. So how one can look at the FY27 capex?
So FY27 we are looking at a capex of around 725 crores.
Okay. That's it from my side. Thank you.
Thank you.
The next question comes from the line of Ankita Shah from Elara Capital. Please go ahead.
Yeah, hi. Sir, I'm referring to your last con call that you mentioned that nearly 1/3 of your Q4 target is already achieved in the first 40 days. Most approval related to project delays have been resolved. Execution pace to normalize from 4Q. And 11% margin looks sustainable. Amid all this commentary that you gave, what is it that you did not see coming through, which impacted the balance 50 days of project execution and margins? What are the key projects that actually impacted this, and you did not see it coming through?
So see, one, we will, let's appreciate that Q4 always remains to be a sizable portion in any year. Now, in the month of March, we had seen a sizable drop because of, as explained earlier, because of supply chain disruption and energy-related, challenges. Many places, the vendors were asking for advance payment and then only they were committing. And despite giving advance payment, many places it was not available. So that became a major constraint. And as I explained that we have got almost 1/3 which comes from overseas market and from the countries that are not having, those kind of energy reserve. So that severely impacted. And some of the projects even in domestic market got impacted in the month of March. So this is something which we were not expecting. And also some of the projects where, the fast track projects we were expecting, because, the kind of discussion we had, because these were all private customers also, we were expecting things to ramp up, but then it didn't pick up.
So, do you mean to say, or can we read it this way, that large part of this impact has been on account of your international projects, which is
Large part is because of international projects, and as I explained earlier also, that the payments, payment has to be something which makes things flow. This got stuck. This has severely constrained us to put beyond the point money by ourselves.
Okay. So how much percentage of impact is on account of domestic projects and export? I'm assuming everything got impacted.
Yeah,
but on
export got everything impacted.
So
Maybe in domestic market, if you have to put a number around say 25% or so, the projects got impacted.
okay. What gives you, given that the situation still remains the same, do you think this issue will continue going forward as well, at least this quarter or next 6 months clarity you might be having, given the kind of experience you've had over the years? What is your read through for, in the near term on this?
This challenge continues to be so, and we have not seen a very sizable improvement in overseas market in terms of energy availability. And what we hear, you might have also seen media, very prominent leaders, world leaders, they have talked about that we are looking at big disruption coming up. So we are also not very sure how to talk anything futuristic at this point in time. But the situation has not drastically changed.
Okay.
And that is the reason we are holding on to the guidance, because once we see some clarity, we'll be giving the guidance.
Okay. So can you give me more clarity on your international projects? Where all do you have the projects, and what is the nature of the work that you're doing there?
In Bangladesh, we are doing a couple of road projects, and we have got a railway project. In Maldives, we are doing one bridge connecting project. Besides that, we are doing a couple of water-related projects in Tanzania. We are doing a water-related project in Benin, in Ivory Coast, and then there are various countries in Africa.
Okay. So, what has been the issue here in these places? I mean, if you can give more clarity, is it supply chain related or local level disruption that you saw?
No, not.
I'm unable to understand that thing.
So usually what happens that in most of these projects, the material goes from domestic market India, and from Middle East. Dubai works as a hub for us. So movement of material became a problem for these places, and usually for our project execution, we require a lot of diesel, we require a lot of gas. So availability of this was not there. Many places we had to give advance, and then only they were committing delivery.
Okay. So this led to increase in the cost, and has the work stopped on the side, or you've continued the work but you've not got the payment from the clients?
So of course, the cost impact was not that severe, but then because of this, the operations could not move in a manner we were expecting.
Okay. Fine. Okay. Okay, sir. I'll get back in the queue.
All right.
I have more questions. Yeah. Thanks.
Thank you. The next question comes from the line of Janam Jain from DAM Capital. Please go ahead.
Thank you for the opportunity. So we have highlighted the delay in the payment from the customer end. So are there any concerns on any specific customer side, or are we facing issue from the government or the private clients?
See, as such, we are not saying that there is concern, but what we have seen is in some of the state there was election, and because of that there was no decision. The payments were certified by the customer, it was sent to the treasury, and the payments were not coming. Some of the customers, we heard that they were not deciding. Payments were certified, it was sent to their centralized finance team, and then we just heard that the payments will be released. It was not released. It was released actually subsequently in the month of April. As such, we are not saying that we are seeing any concern, and I think in past we have talked about Jal Jeevan Mission, which continues to be in UP. They have taken a stand that wherever people are completing 100%, then only they'll release the payment. This is contrary to the contractual condition, but this is how it has been taken up.
Okay. So basically there was some spillover of receivables from March to this quarter, and we have seen a relief of the payments in this quarter, right?
Yes, it's not only limited to quarter. Actually, what we are trying to say is that the payments are getting elongated. As such, it's not that the payments are stuck, the running bills payments are stuck, but then in manner it used to come, or we were expecting, it is not coming in that manner.
Okay. Okay. And sir, my second question is, is there any plan to bid internationally on the ME side, given that Abu Dhabi has unveiled its $55 billion worth of dollars of project pipeline?
He's saying that Abu Dhabi is coming out with some $55 billion better list of course.
No, we are definitely at it, and sooner than later we'll start bagging projects in the Middle East.
Okay. And so currently, would you give any bid pipeline number for now, for this year?
Bid pipeline.
So yeah, sure. Our bid pipeline remains healthy for the next 2 years, which we track. It's close to 4 lakh crores, which we are tracking across segments. And out of that, 70% is domestic and 30% is from the overseas market. As MD sir just mentioned, that Middle East also looks like a big opportunity once the war gets settled. So that area also we are looking, and there are many large value projects in our pipeline, which we are expecting to convert soon. And basis that, it gives us a confidence that this year we are giving a guidance of 30,000 crores for the order booking.
Okay. So do we have any bifurcation for this bid pipeline of 4 trillion?
Yeah, I have the bifurcation as well. So out of that 4 lakh crores, around 96,000 crores is from the hydro and underground business, which includes our water business as well. Around 90,000 crores is from the marine and industrial. It will be like 50-50 distribution. Our rail and road business will be around 85,000 crores, and remainder around 1.3 lakh crores is from the urban infrastructure business, which includes metro, underground, elevated, and elevated corridor projects as well. So that's how the distribution looks like.
Okay, sir. That answers my question. Thank you so much, and all the best.
Thank you. The next question comes from Parvez Qazi with Nuvama Group. Please go ahead.
Hi, good afternoon. Thanks for taking my question. So you mentioned that in Q4 we had a sizable provision in one project. So would it be possible to get a quantum of the total provision that you made in Q4 across all projects?
In Q4, across all projects, we have done a provision close to 160 odd crores.
And what would have been this number for FY26?
FY25. FY26.
26.
26, the number is close to 325 crores. See, Parvez, I'll just explain you. What we have done is, this year we have, in Q4, what we have done is we have made a ECL provisioning matrix. So earlier, what we used to do is, as per accounting standard, we used to look at some previous periods, what is the write-off, and basis those averages we used to make provision. And then in some specific project where we used to think that there could be some challenge, we used to make those specific provision. But this time around, rather than sticking with that individual assessment or individual basis that we used to make provision, this time we have made a matrix wherein we have moved from earlier basis, the management judgment provision, we have moved to a matrix wherein basis aging and basis category, we have made a provision matrix. So it will be automatically provision will be made. All the receivables, and so there was some extra provisioning required because of we had to shift to this new matrix system. There was some extra provisioning required, which we have done.
Also, we have done in one of the projects where we had an arbitration award where we could be taking a call as to contest or not. We thought it is prudent to provide for it. So we had provided for that. That is also a significant amount. Plus another of the projects where there is a cost increase in terms of our marine spreads and other things, which we thought it is, while it could get compensated in due course of time, we thought it's upfront, we'll book the cost, and later on as compensation comes, it could be a plus side that time. That is how we had, as per our usual conservative accounting policies, that's something we have done upfront.
Sure. So to summarize, I mean, if one adds all these, which is extra provision due to a new policy or a cost incurred in a marine project or some provision for a potential claim where we have to decide a strategy, I mean, what will be the quantum of these one-time costs in Q4 across all these categories put together?
I think all this put together, the quantum could be around, say, 265 crores.
Sure. And second question is, what is the capex that we incurred in Q4 and FY26?
So in FY26, we have incurred a capex of 1,069, and this number was in December. This number was around 370 odd crores. So in Q4, we have done close to 700 crores.
Got it. I think that's it from my side. Thanks and all the best.
Thank you.
The next question comes from Bhavik Shah with Invexa Capital LLP. Please go ahead.
Yeah. Hello, sir. So my first question is regarding the current order book. Can you help me with the split of, say, the fixed price order book in it and the variable cost order book in it? And also in the fixed cost, how much of it is going to be impacted, say, with the margins which may not be at our normal margins now?
In terms of our existing order book, nearly about 10 to 11% only is currently in the overseas segment. All 13% is the overseas segment. All others are domestic segment. As you know, domestic segment we have a pass-through mechanism, and international segments we don't have a pass-through segment. And therefore, our impact, and most of these projects which we are talking about is on the closing stages. Other than the fresh order which is received in the current quarter, all others are in the final stages of closure, and therefore we do expect a limited impact in terms of the existing cost escalation or other things. In the new project in the Croatia, beyond a particular level, it has a pass-through mechanism in that contract. Up to 10% additional cost we need to absorb. Beyond that, it is a pass-through. That's something which is there in the new contract.
In the projects you mentioned in Bangladesh, Maldives, Tanzania, and Benin, you executed this quarter, what will be the quantum of these? Because you're saying a large impact came from these projects. So what is the quantum of these projects?
Can you come again?
So you told the Bangladesh road rail project, the Maldives project, the Tanzania water project, the Benin project, all of these were slow moving during the quarter. So can you help us with the quantum of these projects?
So, in the overall order book, the quantum at this point in time, the overseas component is around, say, 13%. But what I have explained earlier also, that even though it is around 13% in the overall order book, but during the year turnover, almost 30% is coming from the overseas market.
Okay. Okay. And sir, so we are saying we have 32,500 crores of order book. We are saying we 15,000 crores of assured inflows and 15,000 crores of inflows are going to bag more. That will take me to around 60,000 crores of order book. And even after having a 60,000 crores of order book, we are not able to give a revenue guidance for the year. So isn't that a little misleading or some like?
No, it's not misleading at all, because the infrastructure industry needs some bit of an understanding where the initial few months it goes towards installation, design and other phases. The revenue starts accumulating in the heavy civil infrastructure project by and large from the second year onwards only. And some of the projects what we have currently in our 30,000 crore, 31,000 crore of order book has slightly long gestation projects. Like if you talk about, there are 4 dams which are about 5-year duration. There is a high-speed railway project which is about 62 months, which is now because of the tunnel boring machine getting extended to another 12 to 15 months. Therefore, these are long gestation projects. Therefore, it's based on the expected order, based on the current order, giving a guidance, especially till uncertainty remains in the geopolitical situation, will be inappropriate. And while on the one side, there have been talks about this thing, our own increase in petrol, diesel is minuscule to start with. In stages, it could get increased. All these will have to be factored in properly. And even now, we find that some places, there are non-availability of fuel in some of the overseas markets, some of the domestic markets in remote places, all this. So those, based on all this, giving a guidance may not be very appropriate. That's the reason we felt it's not appropriate to give a guidance.
And see, we are not saying that we are not giving guidance. What we are saying at this point in time, we are just holding on. We just want to see the visibility, how things are panning out. Because see, what I am saying is, see, cost may go up. If there is a confirm order, you may incur some extra cost. But the continuity continues because of the payment flow. That is where we are seeing that there are certain uncertainties. That's where we want to see some visibility that how things are moving.
And also,
so if a customer,
also, though we are giving a guidance of 30,000 crores, we have to see at what point of time the project comes. Because we are also seeing that the project cycle, award cycle is getting elongated. So if the project comes in Q2, Q3, accordingly it will impact the revenue. So that is also one of the reasons.
Right, sir, understood. And so in case of, say, the customers are elongating our payments, not giving us on time, do we have any rights to maybe get those payments earlier, or how are we negotiating with them currently? Because it will impact our margins for sure.
I see, that is correct. See, usually what happens is in construction contract, we are not at least with the government customer, we are not negotiating per se, individually the contract condition, because once the tenders are out, the contract conditions are set in that contract, in that project. So basis that everybody bids, and then once whoever gets, he has to follow the same contract condition. Now, many a times what happens that if your payment is getting delayed, then you will have a provision of charging interest to the customer. All that is there in the contract. But in practice, what happens that the customers, if they are not seeing the visibility of releasing payment when they don't have funds, they will not certify the bills. And being government entity, you don't want to get into a confrontation kind of a mood with the customer, because that is also not advisable. So till now, the way we have operated is we have tried to deliver projects, we have tried to in advance, we have tried to solve customers' problem, and basis that goodwill, that because of those performance aspects, we were getting our things done. At this point in time, we are foreseeing that there are some challenges related to liquidity, and that is kind of creating this kind of situation. Otherwise, we are not having any bad experience with these customers, because our customer selection is quite we are quite focused on our customer selection.
Understood, sir. Understood. I wish you all the very best for the year. Thank you so much.
Thank you. Participants, in the interest of time and fairness to others, please restrict yourselves to 2 questions. For any more questions, you may rejoin the queue. The next question comes from the line of Shri Narayan Mishra with Baroda BNP Paribas Mutual Fund. Please go ahead.
Thanks for the opportunity. So you highlighted that you are delaying execution of few projects because of uncertainty on collections. So if you can highlight, what is the order book which is facing this issue of collection, so as to gauge, how much impact we are facing. And related to that, also projects with less than 10% completion, what is the receivable on these projects?
See, I think, specifically, if we have to talk about project, I think other than UP Jal Jeevan Mission project and maybe, project in Gabon, we don't have any specific names to be given. What we are saying is, in any project, what we try to do, we have our own internal threshold that, this many months of turnover, if it is not realized, then beyond this we are not going to fund, and we try to manage the project from the project cash flow. So if the payments are elongated, because many a times it happens that they will try to bunch up, 2-3 months bill will be hold up. So after that, we try to go slow. We don't fund from our own pocket. Payment comes, then we try to manage the project, and this is how things are going. And this has got a overall impact. What we are trying to say. Specific project, if we have to talk about, we have already talked about UP Jal Jeevan Mission project, and we have tried to explain that there, contrary to the contract condition, the customer has taken a stand that whoever is completing the final connection, so it means that one needs to complete 100% those connections, and then only they'll be getting paid. So wherever we have completed, say 60%, 70%, 80%, the contract condition says that progressively the payment needs to be made, but now they have taken this stand that final connection, 100% completion, then only they'll release the payment. So in normal course, maybe, we could have done maybe say anywhere around 60-70 crores monthly turnover, but then now, given the kind of situation, we'll be completing those, wherever we have reached say 90%, those kind of, so we'll try to complete that 100% and we'll get that money, and from then that money we'll try to complete the, remaining, maybe then we maybe look at wherever we have done 80%, likewise we'll go.
So what I understand is then the collection problem is widespread. It's not limited to certain projects, right?
Absolutely.
Okay. And also less than 10% completion projects, what are the receivables there, outstanding amount?
So receivable is not that significant there. There are receivables, maybe say it will be around 2 months receivable will be there in such projects. Okay. And just last question on this interest-bearing advances that we are getting, that proportion is increasing. So on the order book level, what percentage of order book will have interest-bearing advances? So I want to have a sense of forward-looking that where this number is going to be finally. And on one side, we are paying interest on advances to customer. Other side, customers are delaying our payment. So we are in a kind of a deadlock situation. So how will you manage this? So it's a big problem. I think, see, we don't look at project selection in that manner, that, if there is we'll keep maybe say 50% only interest-bearing advances, because this is not how we look at. What we look at is, in any project, what is the threshold of margin we are looking at. And generally, these projects we are talking about, we are paying interest is for sure, but then in these projects we have better margins. Unfortunately, we are at a time wherein we have not crossed the threshold wherein we recognize the margin in the project, and on the contrary, we are paying the interest. So that it is getting reflected. But then I think once the top line kind of elevates, we will not have this kind of a situation.
But where this number will go? Because
I'm sorry to interrupt, Sri Ryan. I would request you to rejoin the queue.
Question on the same question. I'm not asking a new question.
Yeah. Go ahead.
So I understand that you don't look at this while bidding for orders, but your ROCEs and ROEs will get impacted, right? If you have higher interest-bearing advances as a percentage of your order book. So how confident are you, on achieving the guided ROC and ROEs if the project?
I think that will certainly impact the ROE, but you are getting the money from the customer, so your capital employed is not there, and ROC, I think that the interest expenditures comes below that, so that will not impact the ROC.
Okay. So anyway, I'll ask a follow-up question.
So I think just to add further to that, we have said that generally our order book from overseas market has always been around 30% or 1/3 of the order book, which is down at the moment. But I think hopefully we'll reach that stage, and then we'll have, because overseas is interest free, and that can significantly improve the situation.
Okay. But I would still appreciate if you can give, in terms of segment or order book, what is this number that will give a forward-looking information.
Thank you. The next question comes from the line of Sriram Kapoor with Jefferies Group. Please go ahead.
Hi, sir. Thanks for the opportunity. Just had a question on your order flow visibility. So the 30,000 crores that you are guiding for this year, what gives you that confidence on, that balance 15,000 crores that you mentioned? You said visibility is in place for about 50% of this. The balance, 50%, what gives you visibility on this? Is it going to be more on the international side or domestic side? Which areas are these projects coming up in? Is the bidding already opened, or is this more sort of, if you could give some more color on that balance 50%?
Balance 50% consists of both domestic and international. And in terms of certain international projects, we are already in the stages of negotiation and closure. So therefore, we do expect things to happen quicker. And in domestic projects also, we have a number of bids already submitted, and there are few more bids in the pipeline. Therefore, we would say there is a definitive visibility in terms of balance 15,000 crore order book as well. We will not be surprised some more of this will come in the current quarter itself, which we are keeping our fingers crossed.
And Shriram, it is across segments. We have good visibility in marine, in urban infrastructure, in hydro, and certain projects in surface transport as well. So visibility is also across the various segments we operate in.